All right, well, let's talk a little bit more about this Fed decision. A lot to talk about on that front. Eddie Gabor joins us now. Eddie's the co-founder and CEO of Key Advisors Wealth Management. And Eddie, let's start with your takeaways from what we heard from the Fed chair yesterday.
I really think from a market perspective, he gave the market everything they wanted in regards to tilting more dovish. The biggest concern was this inflation data that we've gotten over the last 3 months showing some acceleration, and the fear that he would say the word hike during his press conference. And he was pretty clear in the fact that there would probably be a cut before a hike. Now, you know, the bond market, I don't know if it really believes that at this point in time. I think that's why we've seen these gyrations in the market and the uncertainty. And yesterday certainly was one heck of a whipsaw from where we were at 3 to where we ended the day. And I think it's just a lot of uncertainty on that front. But from Chairman Powell's viewpoint, I took it as dovish and bullish for equity markets, where this correction we're going through right now more than likely is a buyable dip for the month of May and should lead to us a pretty strong summer when we look at the fundamentals here in the near term. What happens after that? All eyes has to be on inflation and the bond market. Those are the two most important things we're watching.
Good to see you, Eddie. So what do you think could lead to a rate increase, and when do you see a potential cut?
So I think if they're going to cut, they'll cut by September. I do think that would more than likely be a policy mistake. And the reason why is I think the markets are fine with status quo where we are here. And I think that's the right move, because the biggest fear that the Fed should have is them cutting and then causing inflation to reaccelerate. Because when you cut rates, that's actually very stimulant to the economy and causes asset prices to go up. So if we do have to have that rate cut, and it does happen this summer, I think we run the risk of the beginning of next year, the Fed having to aggressively hike. Because, you know, when you look at labor costs, when you look at commodity prices, they're not coming down. If anything, they're accelerating. And so by the time we get to the fourth quarter of this year, and you look at the base effects and the year-over-year numbers on these assets, you could see inflation and CPI headline number ticking up back towards that 4% number, and no one wants to see that. So it's a real tricky spot here. Again, I think it's bullish tactically here for the next quarter. But once we get to the fourth quarter of this year, I think you're going to see that inflation number become a real problem.
Well, a key point you brought up there, we're headed into the busy summer driving months. What if we see $100 barrel oil? Could Powell be forced to hike rates?
Absolutely. I think that's obviously the biggest risk, because that certainly isn't priced into anything. And look, let's not obviously forget the unfortunate situation happening in the Middle East. Things have been calm the last 2 weeks over there, but you know, tensions are still high. So you got the summer months, to your point, where demand is increasing. You also have the global economy coming out of a recession. You look at Europe, you look at places like India and areas like China, they're starting their recovery process. So that also adds pressure to oil prices. And then if you have the war escalate, $100 a barrel is not out of the question. And if we do get to that, then again, I think you're going to hear hike versus cuts. And this is why energy is really one of the areas we're most bullish on, because I think that's an area that can do well in either one of those scenarios of rate cuts or leaving them the same or rate hikes.
Yeah, we've seen a lot of momentum, certainly in the energy sector of late, Eddie. As investors look at their portfolios today, they think about readjusting heading into the summer months based on what we heard from the Fed chair yesterday. What are buyable dip options that you referenced earlier in the market?
So I think if you're in the camp that inflation is going to stay sticky and maybe accelerate, you want to own things that are going to do well in that environment. And one of those is energy. We actually bought the dip in energy yesterday. It was down pretty good during that sell-off yesterday, so we added to our exposure there. Also some broad-based commodity exposures where you can get some gas, you can get copper, silver, gold, these types of things that can do well in an inflationary environment is where you want to be. We're patient on technology right now. Technology is certainly broken down quite a bit from the highs that we saw a few weeks ago. We will look to add to that, but we want to get through earnings season. Apple tomorrow will be watching that guidance after the bell. That could cause some more pressure on energy in the semiconductor space. So we will add to those and keep our core holdings in large cap. But owning commodities and energy is certainly where we're most bullish. And I'll add emerging markets to that. We've been bullish on India. Emerging markets is an area that can give you some exposure outside of the U.S. that can do well in an environment and offer you a hedge when things are volatile here in the U.S. So looking outside of the U.S., I think, is critical in this juncture as well, too.
Certainly all eyes on Apple earnings later today. One thing Kristen's been talking a lot about, because she's been hearing it here, is the term stagflation. And Powell addressed that yesterday, probably as one personality moment during the press conference when he said he doesn't see the stag nor the flation, which was a nice little spice, little personality for Powell. What do you make of that? Do you agree with his perception that he's not seeing either side of it?
It was a great soundbite. I hope it doesn't come back to bite the Fed, but I think it's too early to say stagflation. You know, we definitely, when we look at the economic data, we did have a deceleration of growth in the last data point that we got and an acceleration of inflation, and that would be deflationary. But you can't just take that one data point and say that we're heading to stagflation. But look, the trend, if that continues, then you're going to hear that narrative go that way. One thing I don't think anyone can argue is inflation has accelerated, and the one question mark is where we're going with growth. And it's too early to see a big deceleration in growth yet, although we did see a data point. So where the Fed's going to be in a really tough spot is if inflation continues to go up, and then we see labor market break down and we start to see growth break down. Are they going to pick the economy or inflation? And that's going to be a real tough decision for them to make. And that's the one area that keeps us very concerned because there certainly is a scenario where you could see that happen.
Eddie, I want to get your take on what the Fed chair had to say about the first quarter data. So up until yesterday, we had always heard the Fed say it was data dependent, and I think that still very much does hold. But it was interesting to hear the Fed chair yesterday say that he wanted to see the entire first quarter of data, that first quarter GDP print that caused those potential stagflation concerns, or at least some commentary down here, as we've been discussing last week in order to make this decision. From your perspective, does it seem as if the Fed might now be moving to a quarterly by quarterly consideration on what to do with rates?
You know, it certainly looks that way based on his comments. And it's interesting, each meeting we kind of get something different in regards to how they want to look at things. Because at the end of the day, the last thing they do want to do is have to raise rates. Everyone knows that if that happens, that's going to be problematic for the economy and for the market. So they want to give it time and space to see really what happens with this data and see if we get any softness on the inflation front. But I would argue that the bond market has already been doing the tightening for the Fed. And that's the thing with these capital markets is it doesn't matter what the Fed does or says. If the bond market continues to go up, that is tightening in itself. So even though they haven't raised rates and said they don't plan to, look at the move in the 10-year Treasury from the end of last year to where we are now. That's been a pretty incredible move. So if the 10-year starts to break through 4.75 and starts heading to 5%, I would argue it doesn't matter what the Fed says. The bond market has kind of taken over here. And this is why watching the rates and watching the dollar and how the capital markets react are going to be just as critical, if not more critical, than what the Fed does.
And that's really bad news for home buyers and really the entire real estate sector as a whole as we see interest rates stay high, if not keep going up above 7. Bottom line, do you think at some point Powell and the Fed accept a number that's not 2%, though they won't admit it now? Do they accept a different number closer to 3?
I think they're going to have to. We're looking at the math, and we just can't figure out mathematically how it's possible to get down to 2% without literally breaking the economy. And you don't want to break the economy. But the way that you get inflation down to 2%, which is a significant move from where we are now, is to create a tremendous amount of demand destruction that causes prices to come down. And again, I think at the end of the day, they're going to have to settle for a number that's higher. Because the result, what they would have to do to get us to 2% is not a world that any of us want to live in.
Eddie, other than perhaps buying some of the dip in energy right now, any other portfolio adjustments that you're recommending to your clients, especially as it might come to cash, bonds, and even maybe CDs as well for some of your clients?
I think one of the nice things with this environment, with rates getting higher, is especially for those that are retired or close to retirement, is for the first time in well over a decade, you're getting paid a interest rate that is acceptable and attractive to have some risk-free assets in your portfolio. Looking at shorter-term treasuries, potentially getting you over 5%. I mean, we were at 0% not too long ago. So we certainly have taken advantage of the short end of the curve, getting those yields. And again, I think in the fixed income space, if you go farther out on the risk spectrum, you can get yields 6 to 8%. They're not nearly as safe, obviously, as shorter term treasuries. So I think now when you're building portfolios, income can be a true part of your strategy where you can get these 5 to 7% yields on top of to hedge with the other assets that have a higher volatility. So if you have money right now, this is actually a great time to have cash and cash-like instruments because you're getting paid a handsome yield.
All right, Eddie Gabor, co-founder and CEO of Key Advisors Wealth Management, joining us after that big Fed decision. Eddie, thank you.